Good afternoon, everybody. My name is Phil Grant. We'll just hold a moment. We've still got a lot of people joining the call, so we'll just hold on for a moment and start in a minute. Thanks. Great. I think we'll kickstart with proceedings then. So, my name is Phil Grant. I'm the global partner lead for Baringa's power generation business. I'm delighted to be joined by three of my partner colleagues today from across our European region. Francesca, who leads our Northern European work, Pavlos, familiar to very many of you, leading our Southern European work, and Mark Turner, our GB and Ireland work. So I'm delighted to be joined by so many colleagues and peers and clients from across the world, actually, a really truly global audience. In terms of today's presentation, we've got about 40 minutes of discussion, and then leaving time for Q&A at the end. So please use the Q&A function that you'll see at the top of your screens. We'll see the questions and be able to respond to those either through the meeting or towards the end of the session. I'll quickly get the adverts out of the way. We're well and truly on the way with our Q2 releases, our projections, our scenario analysis for the global power markets, Europe, Latin America, North America, Asia, and indeed India now. We cover about 70 power markets globally. For those clients amongst you, the reports will be finding their ways into your inbox over the next few weeks. Now, today, we'll touch on some of the price outlook for those markets, but we really wanted to explore some of the thematics beyond the curves. And we'll be covering three discussions. Mark will be leading us on a discussion around the change in composition, characteristic, and outlook of the demand side, and what that means for security of supply, what it means for megawatts and the types of megawatts that are needed on the system. Francesca will then lead us on a discussion around the commercial structures underpinning assets, both for off-takers and generators, the evolving nature, the business case to manage risk and revenue for the growing merchant exposure that we see. And then finally, Pavlos will pick up around the investability in the sector and implications for investor returns, all grounded in the outlooks that we produce on a regular basis. We are very slide light today, so we have one or two slides. What we will do is follow up with a written note and a summary of the discussions today. But this isn't a PowerPoint presentation. It's a discussion with my three colleagues. So just a little bit of scene setting. It's now nearly 2 years, somewhat unbelievably, 2 years since the record highs, the extreme volatility that we saw in the market in summer 2022, the events associated with Ukraine, the geopolitical uncertainty that was manifesting across the marketplace, resulting in some extreme price movements both on the gas and the power side. Gas hitting 250 euros per megawatt hour, power prices spiking over to 500 euros per megawatt hour. And at the time, government's immediate response was to prioritise near-term affordability and domestic security of supply. So really prioritising those two elements of the trilemma, arguably at the expense of short-term decarbonisation efforts, although clearly the growth in renewables, the growing independency that the renewables offers, clearly part of the medium-term agenda. Since then, actually, over the last 18 months, really since December 2022, January 2023, the markets have fallen back into a somewhat benign state. And I say that with an element of caution in my voice. It's always hostage to fortune when you make those type of statements with an audience like this. But we're now seeing TTF gas prices hovering around the mid 30s, 35 euros per megawatt hour, forward baseload power prices across Europe in the realms of 70 to 80 euros per megawatt hour, slightly above, but not massively dissimilar to the price levels that we were accustomed to in the run up to COVID and indeed the preceding decade. We are, interestingly, seeing a large divergence in outturn spot prices across the European markets. Spain, and I'd be interested to hear Pavlos's views on this later on. Spain showing extreme volatility and some extremely low near-term spot power prices. So a little bit of context there for the time that we now see ourselves in, and we've seen this period now of relative stability for consumers and probably policymakers as well. But I guess, how far away are we from that geopolitical shock returning? Have we been lulled into a false sense of security over the last 18 months? And how close to a period of volatility are we now? And perhaps that's by way of introducing Pav to the discussion, Pavlos, perhaps you can pick up with your initial thoughts on, are we now looking at a period of relatively stable prices going forward, or how close to a reversion to extreme volatility of 2022 are we?
Thank you, Phil. I think this question of a false sense of security is a really interesting one to explore. And I do think there's something there. I think when it comes to power markets, you can't talk about security of supply in power markets without talking about gas, because gas is the marginal fuel in most European countries still today. And when we look at the gas market itself, there is an element of tight supply conditions for the next 3 years. I think from 2026, 2027 onwards, there's quite a lot of capacity coming to the market. So from that point onwards, you could make the case that perhaps there is some oversupply in the market. But I think for the next 3 years, we should be prepared for volatility. And we've seen it already, for example, earlier this month when there were concerns from Norway. So I think what has happened with gas markets is we are increasingly dependent on LNG now, and global developments can easily move from a tight to an oversupplied or vice versa situation in Europe as well. So I would say hopefully the worst is behind us, but I would caution that there could be quite a lot of volatility, especially in the next 3 years ahead.
Okay, thanks. And Fran, from a Northern European perspective?
Yeah, it was almost like start from a statement, right? I don't think it's false sense of security. It's more like the whole industry stakeholders are catching a breath after like a roller coaster, 24 months. So I think people are much more aware of the drivers of that volatility, namely gas, that Pav has just mentioned. So I think there's a much bigger and better awareness across all industry stakeholders around what could provoke more volatility, more spike in prices, more ups and downs in the, I would say, spot forwards, alike as the more near-term markets like intraday pricing, balancing energy, right? So I think there's definitely, I would say, the industry has learned, or at least has a very recent memory that can go and use to interpret the short-term signals that we may have over the next 2 to 3 or 5 years, let's say. They're definitely more on the horizon for, still heightened volatility in this space. But it's really catching a breath with a renowned sense of, I know how the market could react. I know what I have to be put in place in terms of contractor structures, investment thesis. So it's definitely some learnings useful to the whole industry.
So in a sense, we're better equipped, both commercially, from a risk management perspective, in terms of the business models that have evolved to manage and mitigate some of that extreme volatility. Mark,
any less panic mode, that's the most important thing.
Okay. And from your perspective, Mark?
I think, in a sense, we've been quite fortunate in Europe in that the last couple of winters have been quite mild. they've been fairly windy, coupled with demand destruction that we saw due to the elevated prices of the last couple of years. It can give the impression that we've sort of sailed through this period. And, of course, the result of that is that security of supply has quickly dropped from headlines and is out of mind. But I'd echo the others. I don't think we should be complacent. We know the geopolitical situation remains unstable in multiple regions, and also capacity margins are relatively tight across various EU markets on the power side. And I'll pick up a little bit on that theme as well as we go through the session.
Yeah. And I know we spend a lot of time as a team debating security of supply standards, loss of load expected, etc. And often it's not a question of the number of megawatts on the system, but the right type of megawatts at the right time. And I know we'll touch on that as we go through to look at the requirements of a lot of our demand side and off takers and the requirements they have around the type of megawatts providing their power. Back in 2022, 2023, we were there was a lot of excitement, I guess, on the generation side. We saw extreme and dare I say super economic profit for a number of different assets in the marketplace. Now, is that super economic profit clearly not sustainable? But should investors bake that into their expectations of returns going forward? Should they be relying on those extreme events to deliver returns in this sector, recognizing that we are looking at an increasingly merchant exposure? Fran?
Well, yeah, if I can share my thoughts on that. So I think relying, it's probably not the correct word I would use. Expect, definitely yes. So we know that a system over the next 5, 10, 15 years will go through very major changes. And in that sequence of changing, you're going to have an imbalance between demand supply of the right type and policy being implemented or things going off, right? The radar for a second to be brought back into balance. So definitely I would say expect that. And with an equity hat on, I would simply say, for your equity case, and that obviously maybe slightly different story there. But from an equity case, you need to expect these sort of events that may create upside. And how do you best harness that upside? So it's really putting in place the right commercial framework for you to be able to harness those events and may create the upside maybe you're seeking to optimize even further your business case. Obviously, on the debt side, the opposite side of the coin. So through the same commercial structuring of your projects, of your pipeline, of your business, how best you can make sure the lenders are comfortable enough to meet the minimum requirements for paying the debt. But still, there's a lot of instruments out there allowing you to do that. So in short, remain exposed to some of the upside because it may will come your way. But in any case, lenders are more comfortable and they do have instruments to protect against downside risk as well.
Yeah. We often talk now with our investor clients about the asymmetric upside in assets as you see this extreme price movement. Mark, from your perspective, have you seen similar in GB?
Definitely. And I think the interesting thing is that the past few years, from COVID, right through the Russian gas situation, have really subjected assets and businesses to a pretty full range of market swings and volatility. So we know it's been a great test of resilience. It's certainly tested some of the extremes of value ranges. And also it's just been very real, very proximate. So in a sense, one doesn't need to believe, solely in projections, which can sometimes feel a little bit remote and a bit distant when we've got, outturned data, which is readily available and top of mind to get a sense of this. So we're increasingly using that view of the last few years to, stress test business cases, both for existing assets, but also overlaying, future assets over that sort of pattern that we've experienced.
Okay, thanks. I think at this stage, Mark, I wonder whether it makes sense for you to pick up and share some of your perspective on the demand side here, because I know that's going to play an increasingly important role, both in terms of the level of growth and the flexibility, both on the demand and supply of flexibility from the demand side.
Brilliant. Yeah, happy to pick up on that. So maybe if I focus now on a few of the trends that we're seeing on the demand side, which I think follows on very well from some of those opening themes. And I think the big point here that I want to emphasize and land is that the growth in power demand in Europe is about to accelerate substantially. We're going to see electrification of existing energy demand, coupled with significant investment in new demand sources as well. And it's quite easy to lose sight of the fact that across Europe, power demand's dropped over the past decade and beyond. Really, since 2010, we've seen a reduction, at best a flat lining of demand. Initially, we had efficiency gains, energy efficiency putting downward pressure on demand. Then we had COVID. Then we've had demand destruction following some of the record price levels of past years. And it's quite an important point that the next decade is expected to look very different from a demand perspective. And I'd raise the question, is the market and is the industry really structurally prepared for that difference, given the lack of historical experience? Just to put that into context, so in our reference case, our central scenario, we see around a 38% increase in EU power demand over the next decade, but there's a substantial range of uncertainty around this. So in our net zero scenario, as a further example, that increase over the next 10 years would be around 52%. And of course, there are various drivers for this. Just going through a few of them, we've got national targets for electrolyzer power consumption. So that alone could reach a few hundred terawatt hours by the mid-2030s. We've got power consumption from EVs ramping up, so maybe another 400 terawatt hours in our reference case in the same time frame from that source. We've got intensive industries, steel production, for example, looking to electrify processes, electrification of heat. So 30 million additional heat pumps by 2030 is the goal that the EU has set itself around that. And of course, we've got data centers ramping up their capacity. So around 9 gigawatts of live demand from data centers in Europe at the start of this year. We certainly expect another 3-4 gigawatts to be added just over the next few years, and then much more beyond that. So I would say that access to energy is without a doubt one of the hottest and most urgent topics in the market today. I work a lot with some of the biggest corporate consumers of energy, so particularly the data center players, big tech players, and that statement is certainly true for them. I think what we're going to see over the coming years is a step change in the degree of competition for energy volumes. We're really going to see, I think, an intensification of that. And I would say there are several layers to that energy access theme. First of all, we've got just access to sufficient bulk volumes of energy. It's really a bulk energy problem. How do you source enough gigawatt hours, terawatt hours of energy, particularly when that needs to be low carbon? I think second, you've got the problem of generation adequacy. So almost the headroom in the system at a national or regional level to support substantial new demand additions. So we touched on security of supply a little bit earlier on in the intro. I think a number of markets are operating in Europe with pretty tight capacity margins, and particularly in the context over the coming years of further phase out of some of the legacy fossil fuel power stations. I think the third layer of that energy access issue for me is then around connections. So access to the grid. Can I get a connection? how firm is it, and how do I navigate the connection process? We know that investment in grid reinforcement is lagging behind the demand for new connections across much of Europe. So how is that navigated? I think then what we're seeing, particularly with some of the tech industry, is particular concern around the growth of AI technologies, which is progressing incredibly rapidly. We know that AI tech results in really a step change, a step increase in terms of the power requirements versus conventional cloud computing. The computational power density is much higher, and the demands for cooling and associated functions are much higher as well. I saw a recent statistic that was claiming that a simple ChatGPT request and fulfilling that consumes around 25 times more energy than a standard Google search, which is a fairly staggering number. I think, though, what we're seeing is, interestingly, some of those AI use cases for data centers actually bringing more flexibility, potentially around the siting and the location of that demand. So as an example, if you have an AI training facility, machine learning and models that are being trained with a load of source data, you don't necessarily have the same stringent requirements for access to fiber backbone and to data connections. So potentially what we could see is an opening up of new locations that are viable for that sort of data center development. And although data centers are essentially baseload in terms of their operation, we could maybe see a little more flexibility emerging in terms of their demand, particularly around those AI uses. I think then, alongside access to energy, I'd certainly still flag the growing pressure on corporates to decarbonize their operations as a major theme driving the behavior of the demand side, not just the leaders in this space and the early adopters, but increasingly across the full sort of food chain of corporate consumers. And we also know the rules are changing in that space as well. So there's a redesign in progress of the greenhouse gas protocol scope to emissions accounting framework. So we know that could substantially change the incentives and requirements for corporates. And I should mention at this point that we're doing a pretty major study on exactly that theme, looking at global scope to emissions and how corporates can maximize the impact of their renewable sourcing. So one, I'll just get that plug in. There's one to look out for next month when we're going to publish a pretty major report on that topic. And of course, the cost of energy remains a huge challenge for the demand side too. So of course, the recent reductions in wholesale energy costs have been welcome, but corporates are seeing rising trends in prices they're having to pay to secure renewable generation under PPAs, and they're seeing increases in some of the non-energy components of their bills as well, so the network and policy costs. So, what does all this mean in terms of the demand side? How should we react to some of these trends and challenges? I've got three thoughts maybe to leave us with. First of all, I think what we're going to see is substantial opportunity for developers and investors in power generation associated with this demand increase. What we may see, I suspect, is a race to secure pipelines of low carbon generation. We've seen already a couple of pretty big deals. We saw the Microsoft Brookfield deal last month. That will underpin around 10.5 gigawatts of renewable projects. It's roughly a $10 billion commitment. There will certainly be further big deals to come. And I suspect we might see a shift in the locational focus as well of some of those opportunities. I think it'd be very interesting, given that scale of demand growth, and the constraints in the supply of renewables, particularly across Europe, could we see a prolonged seller's market? Something I might see whether Francesca wants to pick up on in a second. I think second then, I think it's more crucial than ever for large energy users to have a very well-formed locational strategy for their growth. So understanding where is there headroom in the system to support more demand, where can grid connections be accessed, and where can the pipeline of grid connections be best defended. And then I think third, I'd say that energy users and the demand side need a really well-considered and optimized strategy to sourcing power. So it's going to be a combination of off-site generation, self-supply, on-site generation as well, and then increasingly sources of low carbon flexibility too. I think your point, Phil, it's not necessarily about just megawatt hours, but having the right types of megawatt hours as well. That will definitely become more important. I think maybe finally, I think that does need to be aligned with a view of the decarb ambition. So where do you want to be as a demand consumer on that decarb journey? And also what is your appetite for price exposure and risk exposure across your portfolio? And both on the demand side and on the PPA side as well. So maybe on that note, I'll pass the baton to you, Francesca, to maybe pick up on the evolving nature of commercial structures. Maybe you can give us a view as well on whether we're now firmly in a seller's market for PPAs.
That's a $1 million question mark. But yeah, so thank you, first of all, Mark. Maybe let's park that question for a second, just for the audience. Let me just go through a recap of what we have observed over the last 24 months or so, just to kind of understand how all those dynamics that we have just discussed and mentioned many times, how they have impacted the way that, in particular, renewable developers and IPPs in general have been thinking about how to monetize the value of the asset. So let me do a bit of a historic recap with some clear learnings and what we have observed as impact on route to market strategies. Then I would love to make a few comments just about the decline in price, the correction downward in prices, what has produced and caused in terms of some of the biggest headaches that developers and IPPs are facing at the moment. And I would like just to conclude with some additional thoughts and reflections about the here, the now, and what I see and what I discuss a lot with my clients for the near medium term. But picking up the 2 months ago type of time frame and walking us through that period. So we said, high prices, volatility in the market, super returns for renewable assets, if we want to call it that way. And allow me just a disclaimer. I'll just focus for a second here on solar and onshore wind. There's a huge, set of considerations for the offshore wind industry, but I'll park that maybe for Q&A later on or for bilateral discussions. But, really focus on that sort of onshore type of technologies. So obviously we see super high prices in the market. So that was an opportunity for renewable developers when looking at the new projects. I'm not talking about the existing project, new projects, really, how do I harness, how do I make the most out of it? And obviously the way of doing that, the way of thinking about that was to get a bigger exposure to market. And primarily, through signing short to long-term PPA deals with utilities, with corporate consumers. So essentially was an ability of capitalizing over that time frame on higher prices, still de-risking their project for rising debt, essentially. But, it was also an opportunity not just to create extra margins, but also to offset some of the huge increase in technology costs we have observed, and capital. I include in that camp also capital costs, so financing cost, cost of equity, cost of debt. So in a way, it was a let me say, a nice way of saying, fine, yeah, I can get more money, but at the same time, things cost more, but on balance, I'm okay. And I can do much more PPAs also because the demand side, obviously the corporates and I've advised a few that really found themselves in tough situations where, say, I'm completely unhedged in the summer 2022, I don't have a hedged position. What do I do now? And there was a rush for locking in high prices, even on the buy side, just not to be exposed to further volatility, further escalation of those prices. So anyway, in short, huge increase in the use, interest, and deals closed around PPAs, short and long term alike. This has meant also an abandonment where those were available of more, plain vanilla, let's call them, route to market provided by governments. An example, Poland, the CFD there was a competitive allocation. Nobody really, for a few years, no one was really looking at that as a way of monetizing. They were just signing high-priced PPAs, and that was probably the key route-to-market strategy that renewables were considering. So, in short, more PPAs, less government-backed solutions, but also a bit more exposure around merchant power prices, merchant revenues. This is just going back to what we were saying at the very beginning, Phil, is like people do realize that there were potential upside to be harnessed. And the way of doing that in a relatively controlled way was to increase the proportion of the total revenues exposed to some of that volatility, some of that increase in power prices. So this is the sort of a scenery and the sort of environment that we have observed up to the back end of the last year. Of all these trends, there were also some collateral damages. Allow me to call them like that. So we have seen, especially in the Nordics, some of the renewable projects at times defaulting on their debt because they had signed in the old days baseload PPAs where basically they were understood, lenders were happy with that. Nordics hydro shape risk was not something that people were thinking of. But ultimately, we have seen, and we are working with some of those clients going through a restructuring of the contracted position into a new way of dealing with that risk going forward. Another collateral damage was the increased cost of balancing, in the sense that obviously, as much as spot prices were going super high, also the corresponding cost of imbalance pricing, intraday prices, so the balancing cost of energy from that sort of a day ahead to real time framework did really go up equally. And there was obviously a higher perception of risk around hedging or fixing those costs for the medium to long term. So essentially, renewable developers, yes, they were benefiting from higher PPA prices to offset some technology cost increase, but in their cost structure, there was also an increase and more openness to risk around balancing cost. So again, a few collateral damages we have observed over the period that on average was quite beneficial for renewable developers. Obviously, as I said, we step into the back end of the last year and early months of 2024. Correction in prices, prices went down. I think the lowest point was around the March timeframe. And here, some of the issues started to emerge now, right? So technology costs were not decreasing as fast as the power prices were decreasing. So one thing we observed immediately, there was this asymmetry of information around, especially corporate consumers, around what are the real costs of the wind and solar I'm buying in terms of the megawatt hours. What's the real cost as well around the firming, so transforming that solar and wind into a profile more attuned to my consumption profile. So essentially what I call the negotiation gap between especially developers and corporate buyers has never been as wide as we have observed lately. And there are now some positive signals around solar, right? Tech costs are declining that camp, but broadly over the end of last year to first half of let's say Q1 or beginning Q2, definitely we have that pricing gap that has to some extent slowed down the number of deals, the number of conversations, the number of appetite of consumers going to market to buy from RES. As I mentioned, the asymmetry of information, there was maybe a little bit of bias around anchoring around the recent events. And I've never seen such a divergent opinions around the value of energy, in particular electricity, going forward. So definitely that has characterized the last 6 months or so. Let me step now into the last few months to the near term. So what we see going forward and what we're observing now already in the way developers especially approach this, there's definitely an increase in sophistication. So it's not sufficient to say, oh, definitely I'm going to go with a CFD, or definitely I'm going to go with a PPA, high price PPA, right? It's not sufficient. So we have a lot of our clients with us or internally dedicating bigger teams, more sophisticated teams around, how do I best put my pipeline to work? What kind of strategy can I adopt? And there's definitely, again, more energy and effort, sophistication spent in that route to market definition. When I just look at the use of the PPAs, there's definitely, and rightly so, after I've been predicating some cases for more than a decade, a heightened focus on distribution of risk and responsibilities between the parties. I cannot count how many times in the last months I've been spending with clients looking at, pre-COD responsibilities and liabilities, treatment of curtailment, what happens, where is the money, how the compensation, if they are available, how they actually distributed from the TSO paying to the market access provider to the developers into maybe the corporate hedge via the PPA, a financial PPA. So negative price is another clause that was already there, but is more and more negotiated very, very carefully, and there's lots of approaches that we can use, and the developers have been exploring, and corporates as well. But I would go all the way to change law, termination clauses. All this set of non-pricing terms have emerged in terms of importance and scrutiny, both parties, being buy side, be sell side, be lenders. So definitely across all the stakeholders behind a deal, a PPA deal. A few other things emerging, definitely, and understandably so, a return of interest and appetite in government-backed solutions. Obviously, some markets have never been abandoned to some extent, but definitely some other geographies, there's both from a developers looking again back to government-backed solutions as a way of de-risking, finding what I call the premium buyers, right? It's not just corporate. Let's not forget, governments could be your premium buyer if you're a developer, right? So definitely a rejigging of interest towards government-backed solutions, governments as well. And maybe Pav, you can pick up on this a bit later in terms of new policy, new regimes, because markets are not sufficient quite enough in the near term to develop the huge gigawatts that we need for transition, for not to lag behind some of the targets. Really rethinking how to put in place updated, reshaped, or extend some of the regimes that are available for renewable technologies as other technologies, right? Let's not forget, it's not just about RES. But anyway, in short, definitely this kind of a return to government regime is an attention and focus for many of our clients. Maybe last thought I want to leave you with is around the sophistication, right? One layer of that sophistication is a lot of developers are approaching, and I say developers, IPPs, but also financial investors backing or buying to platforms, but buying to maybe a portfolio of assets, looking more and more things, the deals, the transaction from a portfolio perspective. So it's not just an asset, a contract, but it's like a number of assets in the pipeline, or a number of technology, a number of different megawatts of different technology and locations and all that. How do I, as a portfolio, make it work? And that becomes, the initial point is increasing maybe a little bit the merchant exposure. Maybe you have a few assets almost all merchant in combination with fully secure, with government-backed, with corporates, or with a utility-backed type of contracts. Really looking at that portfolio dimensions. And we're doing also, with our clients, more and more analysis about what it means. I'm sitting on this portfolio. What if I add that sort of contract into my pool of, the commercial structuring of my investment? What if I add a different location, different technology, different proportion of? So really a lot of guidance we've been providing to clients on that portfolio implications, not just on the megawatts, on the contracting side, and on the structuring of value of your investment going forward. Maybe I'll stop here. Hopefully there's, happy to pick up some of the Q&A questions, and maybe Pav, you can take some of the thoughts that I shared and, walk us through what we've seen from all our clients, and more with the investor type of hat going forward.
Yeah, thank you, Francesca. So for the last bit, I'm going to focus on the power generation value chain. And in particular, I will touch on the latest trends that we're seeing in valuations and M&A activity with a focus on renewable developers and IPPs. Mark touched on grid and curtailment considerations, which are becoming increasingly important. And I will also touch a little bit on supply chain considerations as well. So if we start with valuations, Phil already talked about the fact that post-Russia-Ukraine, we saw a very significant rise in valuations that investors were paying for development assets. There were two reasons for that. One was the very high power price environment that we were operating in, but also the realization that significantly greater volumes of renewable capacity would be developed as policymakers revised upwards their renewable ambition targets. In the past 12 months or so, we've seen prices declining, but there's also two more important trends that are worth mentioning here. The first one, and Mark touched on that earlier, is that I think there's a consensus view across the industry that it is grid rather than permitting or authorizations or financing or PPA offtake. It is really grid that is becoming the single most important constraint when it comes to financing and developing renewable assets. And so what we're seeing is that the valuations for renewable assets under development are now increasingly driven by the quality and the location of grid connection, and what is the potential curtailment risk that those assets are exposed to. And so here, the track record of individual developers, their specific capabilities on grid are becoming an increasingly important differentiating factor. In the transaction that we're working on, from our perspective, when investors are analyzing renewable portfolios under different stages of development, we would strongly advise against the historical approach of just using a blanket percentage figure for the probability of success for these assets. Instead, what we believe should happen going forward is carrying out a detailed bottom-up analysis for individual assets, depending on where exactly in the transmission or distribution system they're connected. And then that analysis should in turn inform the probability of success and the resultant valuation for those assets. So that point on bottom-up analysis is really important. And then the second point that I'd like to make, and my colleagues touched on that point earlier on portfolio effects, we are seeing that the perceived value by investors is swiftly moving from project development into trading and asset monetization. In other words, the perceived value of vertical integration and portfolio optimization is certainly increasing, and the capabilities that developers and IPPs have for monetizing assets are becoming increasingly important in the due diligence process that we're involved with. So we're seeing more and more pure play developers pursuing that story of becoming fully integrated IPPs with their own trading and asset monetization capabilities and with activity across multiple geographies and multiple technologies. The point that we would like to make here is that just because something looks good in a sales document, it doesn't mean that it will be for everyone. The move that I'm describing will require a whole set of new capabilities to be developed. You know, when you think about technology perspective, financing, collateral requirements, and you need to make sure that all of those new capabilities that will be required align closely with shareholder risk and return expectations. So it won't be for everyone, and it needs to be carefully studied with the risk and reward trade-offs. Going back to grid, we said that it's now the key constraint for developing and financing assets, and it's worth spending just a couple of minutes on what that means. Mark mentioned earlier that grid capacity is getting more and more scarce in Europe, so it's becoming increasingly important to carry out the bottom-up analysis of the location that assets are connected to. So what that means in practice is they need to understand for development assets the connection date that they've been given by the TSO and DSO, and what is the risk around that connection date, because we're increasingly seeing those dates being pushed back and back. They need to understand historical and future levels of curtailment risk, which means that they need to have a very clear picture, for example, of what is the renewable assets, the batteries, the hydrogen electrolyzers, large industrial loads, grid reinforcement projects. They need to have a clear view on all of those developments in that particular region that they're connected to. And they also need to understand curtailment compensation rules, which unfortunately are not harmonized at all across Europe. Those can impact cash flows, they can impact financeability. And what we're now seeing is that European lenders are becoming very attuned to those curtailment risks, and they're demanding that this kind of analysis is incorporated in the risk analysis that they're doing before financing assets. So comprehensive grid analysis, comprehensive and integrated grid strategy should be right at the center of the development strategy of any modern European development, to make sure that the DevEx is spent optimally on the best projects, particularly from a grid perspective. And also, Francesca alluded that earlier, there's a clear mitigation strategy for projects that are located in constrained areas. So that can include, for example, storage collocation, demand collocation with hydrogen or even data centers, or potentially looking to pass on some of those curtailment risks via the contractual terms of a PPA. So that's some thoughts on grid. And then finally, just to touch on supply chain considerations, I would like to invite anyone who is interested in supply chain to read our recent report for the Department of Energy Security and Net Zero, DESNZ, in the UK. You can find the report on our website, or if you just search online for Baringa Supply Chain Report, DESNZ. The conclusion from that study is that there is significant national and international competition for components and installation services, and that is now contributing to supply chain constraints. Without significant coordination across industry and government to resolve those supply chain constraints, it will be difficult to meet our renewable deployment ambitions. From a technology perspective, we're finding that supply chain issues are most severe for offshore wind and offshore wind transmission sectors. But there are some supply chain considerations also for onshore wind and grid scale solar PV, although those are probably not as material as grid constraints that we touched on earlier. The implications of the above for asset owners and operators is that sourcing and managing supply chains must also become a strategic priority for any modern European energy transition company. And those companies need to be able to plan more carefully than ever. So that applies both for individual projects as well as for managing large portfolios to maximize efficiency and make best use of resources. So quickly, some of the key success criteria that we're seeing companies successfully deploying here. Firstly, is that they need to be able to plan early and being proactive rather than reactive, particularly given that some components, for example, transformers, switchgear, HVDC cables and converter stations, we know that these components have long lead times. So they need to be carefully planned from the start of the project, taking also into account the fact that historical lead times may not necessarily apply for new projects as well. So that means that you need to develop strong relationship with the supply chain, constantly running soft market testing exercises to understand costs, timelines, and deliverability, and that needs to be part of the development strategy. Secondly, it is really important to carry out due diligence on your suppliers. This is not just about costs and ability to deliver. This is also about domestic content, for example, which is becoming increasingly important, wider ESG criteria. And here I think we're seeing some long-term relationships and partnerships being established. We're seeing some companies pursuing even more creative methods like targeting acquisitions, for example, so increasing their vertical integration across the supply chain. Or we're seeing shareholder agreements to secure components and decrease price volatility. So getting creative here is going to be important. And then finally, good project management practices also apply here. So understanding the knock-on effects of delays, building resilience and diversifying your options as a supplier, investing in risk management capabilities, etc. So the key points that I would like to sort of leave you with is that grid and supply chain capabilities should be at the center of the strategy of any modern European developer. And also, whilst we're seeing value by investors moving from project development into trading and asset monetization capabilities, that move of becoming a fully integrated IPP probably won't be for everyone. And so it needs to also closely align with shareholder risk and return expectations.
Great. Thanks, Pavlos and Mark and Fran. So that was a pretty rapid canter through some of the more complex themes that underpin the outlook for European power markets. Demand, the flexibility coming from demand. I do find the point around flexibility, or the flexibility that AI can offer to the power sector, absolutely fascinating. By arbitraging across your processing power globally, we'll have it's effectively acting like some global arbitrage mechanism, which I think is absolutely fascinating from the perspective of risk management. And then, Fran, the evolving complexity to manage that risk, and the business models underpinning some of the investments going forward, and Pavlos, the implications for asset development, return, and supply chain. So I would like, just if I could be very specific, and I know this isn't one of the questions, but I'm going to throw it in anyway, Pavlos. I just want to return very briefly to the growing trend around platform build out from IPPs and the development of, say, route to market capability and commercial capability, which clearly we're seeing across our client set. But to what extent is that driven by a risk management issue? Is it driven by access to the upside that Francesca was alluding to, or at least recognition of the upside that's foregone through sort of more fixed price products? Or is it in fact driven by a repackaging of the asset for a capital event in 2, 3, 4, 5 years' time? What was your sense of the drivers behind that trend?
Yeah, and I think we've seen different stories being pursued by different companies. So I think this is very much kind of company dependent, but I would probably highlight the first factor that you mentioned, Phil, which is around the upside. So I think people can see that with the rise of volatility, the rise in traded products, I think they can see that there is significant value there of making sure they can capture the upside of high power or volatile power prices, combining portfolios, combining technologies and geographies. So I think that's sort of the story that I'm seeing more being pursued, rather than necessarily the risk management point, which is also important.
Okay.
And Phil, if I can add there, is I think there was a bit of a reaction as well from IPPs and developers not finding the right product in the market at the right time. So in understanding obviously, apart from the upside, harnessing the upside, is also about the flexibility and at times the fragility of not finding what you need in the market. So if you're doing that internally, having the capability internally definitely allows a more optimized way of bringing forward to fruition a pipeline. So I've seen that story as well with quite a few of our clients.
Okay, thanks. Do use the Q&A function there. If we won't have a chance to address all the questions in the final few minutes here, but we will make a point of getting back to you on an individual basis. And I know there's 1 or 2 questions here that we'll pick up directly with the individuals, but do drop anything in there that you want to pick up on. Nicholas asked a question around European elections and market design. I don't think it's just European elections, there's a whole plethora of elections with some announced overnight as well. And how that will impact on incentives, market design, and I think we should also consider the US in the answer to that question as well. Pav, do you want to kick us off on that one?
Yeah, I can share some thoughts on European Parliament elections. Obviously, that we've seen the results over the weekend. I think it is true to say, and that's been sort of widely reported in the media, that climate change and the energy transition have probably lost a little bit of the centrality in public debate that they had previously. And we've seen, for example, Green parties not doing particularly well in those elections. But what I would say is, do not write off how important of a macro trend the energy transition is. Mark was talking about earlier AI and new technologies. Europe will have to be more competitive than has been historically, and there's a lot of policy shift now on competitiveness. And having a really strong energy transition policy and really strong ability to attract investment on things like AI and renewable energy is going to be massively important. So I would say whoever is in power will have to make energy transition a key part of their overall policy making, even if we've lost that debate a little bit in recent days.
Yeah. Okay.
So I think it'll be as much about economic growth as it will be about just sustainability and climate goals.
Understood. I'm slightly at risk of throwing my colleague Mark Turner under the bus here, but obviously we have a domestic election coming up in 3 weeks' time. Any perspective on alternative policies, or still too early to say?
Yeah, I think without straying into too political a territory, Phil, I think actually it's pretty well aligned with Pav's view of the broader European landscape, which is actually the main parties may differ in some of the detail, but the overall ambition is not vastly different. So I think certainly in the UK, regardless of which of the two front runners is elected, I think the overall pace will still need to be pretty swift in terms of rollout of renewables, general decarbonisation, and actually the pace is probably not going to be dictated by the level of ambition, but rather some of the other bottlenecks and enablers that are required. And in a sense, I think the sort of effectiveness at getting some of those enablers moving at pace is probably the biggest opportunity and potential win, I would say, from any particular political outcome. So it'll be fascinating to see what comes out. But I think in terms of policy ambition, I don't think that's going to be the limiting factor around pace.
Okay. Yeah, understood. Thanks. Very, very briefly, one final question. We've gone through an hour here. We haven't really talked about batteries, and when we think about the asset class that's keeping us particularly busy at the moment, yeah, batteries is very much at the fore. Fran, when you talking about commercial structures there for solar and wind, what are some of the nuances and differences you see when you think about the battery business case?
I think I would say what comes up to my mind when you ask this question is the immaturity. So I know we've been discussing for years about batteries. The technology is there. Obviously, we have some new technologies emerging, maybe in the battery storage space. We talk about long duration storage. But I think there's lots of immaturity, right? When we are helping clients and negotiating contract structures, it could be a tolling agreement, a floor, a purely merchant, or even helping some of the companies setting up themselves to be able to trade and optimize their own assets. There's a lot of exploration still, right? There's a lot of let's try this, let's try that. There's not like a single way of doing things. So even when maybe our colleagues as well are helping, large utilities, big names, right, of the energy industry, they're not fully set up to trade and optimize. I call it flexibility. It's a very simplistic way of calling that. So I think there's a lot of appetite, there's a lot of interest. It's definitely going to be part of any generation mix, any portfolio of an integrated operator in the space. But there's a lot to be done, let's say, in terms of solidifying the behaviors. Also lenders, they still don't know quite yet how to test this and that. So we're doing a lot of scenario model of downside risk for them, a lot of due diligence around the optimizers' capability of fulfilling their profit promises. Yeah.
Great. Thanks for that. We are now pretty much up against time, and I can see people steadily dropping off the call. So thank you all very much for joining us this afternoon. In particular, thanks to my three colleagues, Pavlos, Fran and Mark. Needless to say, please do get in touch with us if there are thematics and points for further explanation. We're always delighted to chat and engage with colleagues and peers across the industry. We will be writing a summation note that summarizes some of the thematics that we've discussed today. But otherwise, thanks very much for your time, and enjoy the rest of the afternoon.
Thank you.
Thank you all.